And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. Yes, we are back live in the studio after being gone last week for spring break. Of course, nothing really happened of any consequence, so not much to talk about. Actually, of course, we had the fastest 10% correction on record. One of the fastest, I shouldn't say the fastest, one of the fastest 10% corrections on record. Very sharp decline last week, of course. Dow posting one of the worst weeks we've seen since 2021. So, again, this obviously led to a lot of rises of concern about what's going on in markets, those type of things. So we're going to get into that today. Also, we're going to talk a little bit about recession fears. This was the subject of this past weekend's newsletter, and that's also been a big headline. Whenever something happens in the market, no matter what it is, the media needs for some, to have some reason to publish a headline is like, this is occurring because of X, Y, or Z. And typically, most of the time, it's wrong. But, we have to do that. It's human nature. It's how we rationalize things. Why is this happening? Well, it can't be happening just because markets were really overbought and you're getting a reversal of buyers and sellers. It can't. That's too simple. That's too simple, right? It's got to be a reason. So the reason now, of course, is recession fears. All of a sudden, we've now got recession fears back in the market. But do we? And so we'll talk a little bit about that today as well. Also, of course, over the weekend, one of the big concerns last week, also kind of weighing on the markets a bit, and again, here's another reason for the market sell-off, was concerns over the debt ceiling, right? And this was the fact we needed to pass the continuing resolution so we could fund the government. We have to shut the government down. And again, as we've talked about this so many times, we have we've had these government shutdowns 28 times over previous history, and the world still goes on. Just nothing. Nothing. It's while these are big pomp and circumstance coming out of Washington to kind of position for whatever you're trying to get done in terms of the government shutdown. It's always a lot of talk, but not a lot of real consequence. And yes, if you do shut down the government, there are certain consequences of that. We lay off, last time we did this, we laid off 900,000 non-essential workers, as we've talked about before. If you're non-essential, why do you have a job, right? So, we're talking about wanting to reduce government spending, but we've got 900,000 plus people that have non-essential jobs. So, there's good job cuts to start with right there. But this always revolves around to, shutting down government parks, shutting down the Smithsonian, temporarily, so you can't go on White House tours, those type of things. What does not get impacted is Social Security payments, interest payments on the debt, military payroll, etc. That gets paid. That is mandatory spending. That's 75% of the budget. That still gets paid no matter what, whether the government is open, closed, out of business, it doesn't matter. Those still get paid. And so there's always these headlines about, oh my gosh, if we shut down the government, people aren't going to get their Social Security checks. Not true. But that's the headlines, to scare people into, doing whatever it is they want to do, right? So anyway, over the weekend, the Senate did approve the spending bill. So now we've got funding for the government through September. That's not a good thing, by the way, because again, it's another continuing resolution. Problem with continuing resolutions is simply you don't cut spending at all. In fact, when you look at the budgets, they say, oh yeah, we reduced defense spending by X amount. Well, no, not really. No, you didn't, because you're increasing your budget across the board by 8% on everything. So yeah, you may tweak a little here, you may tweak a little there just for the sake of headlines, but in reality, you're increasing spending by 8% a year, and that's this is the problem with continuing resolutions. We take last year's spending, tack 8% on it, and we've been doing that since 2009 when Obama first took office. We have not had a budget since then. So if you can do the math, the rule of 72, you double your spending every 9 years at 8%. So we've already doubled it. 2009 to 2018, you doubled your spending. 2018 to 2027, right? 2 more years, we will have doubled it again if we keep down this path. At some point, we've got to return back to actually having a freaking budget that we can actually work on to cut spending and understand kind of where money's getting spent. But again, this has become too challenging in a very divided government to do a budget. So, at some point, we kind of got to ask ourselves, kind of what's going on. But the good news is no government shutdown. The bill was passed. And so that's going to ease some of the burden on the market here, at least temporarily. Markets are, of course, going through a correctional process as well. So let's talk a little bit about that. Here's what you need to know before the bell this morning. The markets, like I said, have a very, very sharp decline. This was the fastest 10% decline that we've seen in quite some time. And of course, that certainly got a lot of people on the edge of their seat. And we've warned about this before, is that, look, markets correct all the time. Markets all the time are going through some type of correction. And when they go through these correctional periods, then that's when investors all of a sudden get really concerned, right? When markets are going up, everybody's like, hey, markets are going up, it's great. When markets correct a little bit, for some reason, everybody gets all concerned. It's like, oh my gosh, it's a recession, it's a bear market, it's the end of the world, whatever it is. It's just sometimes the markets need to have a correction. And that's all that's been going on here as of late, is that we were extremely overbought on multiple bases. And again, when you get really, really overbought, you're going to get price corrections. And again, this is all that's happened here, is that we just simply worked off a very overbought condition in the markets. Now, as humans, as I've talked about before, is we have to assign a reason for this, right? Why, oh my gosh, why is this correcting? Well, it's because of a recession. It's because of this. It's because of that. Reality is just that markets were very overbought, and that sometimes you just have to have a reversion back to the means. And that's all that's been occurring here. We reverted back to moving averages again. You cannot have a moving average unless the price of the market trades both above and below that average over time. That's where the average comes from. So again, averages are like gravity. When you deviate too far above these averages, you're eventually going to have a correction. And if we look back at the markets over a very, very long period of time, guess what you see? Lots of retests of those averages over time, above and below that. That's just simply how markets work. And again, this is why it's very important to keep a focus on what's actually happening within the markets and keep a watch on where your allocations are. And this is why we regularly talk about when markets are very overbought. What do we say? Take profits, reduce risk, rebalance. It's like, well, Lance, you're always saying take profits and reduce risk. Markets keep going up, right? You're missing out. This is why you take profits and rebalance risk, because again, you're going to get these correctional periods. Now is the time to start looking at putting that cash that you took out of the markets by reducing risk and rebalancing portfolios. Take that cash now, put it back to work. You've got a decent opportunity here. Markets are very oversold. Starting to see a bit of a turn up in relative strength on Friday. Again, we're not probably completed through this bottoming process just yet. What would be great here is to see this market get back above the 200-day moving average. We do have a lot of resistance kind of coinciding right here around 59.50-ish. So again, that's going to be a real challenge. That's the 50-day, the 20-day, the 100-day, all kind of colliding at this one area. So again, that's going to be big resistance. So again, you get a rally here. This is going to be a really good opportunity. Review your portfolio and say, okay, what was not working at the market high and what outperformed on the way down, and then look to rebalance your portfolio a bit. Again, if you had a bigger decline than 10% in your portfolio, this is a really good opportunity to go, how much risk am I taking? How much leverage do I have? What are the things I'm doing that are creating bigger downside risk in the markets that I'm comfortable with? Use that rally to rebalance that structure in your portfolio so you don't have that kind of risk. Because again, we're not through with volatility longer term. We're going to have more bouts of volatility over the course of the next year as the markets deal with tariffs and economic changes and governmental policy changes. Those are going to continue to weigh on markets. Earnings are too elevated. Those have to come down. So again, more volatility this year, as we've been talking about. Use a rally that we get here, whatever it is, to put a little bit of rebalancing in your portfolio. That's what you need to know before the bell this morning. When we come back, we'll talk about recession risk on the rise. Are they not? Talk about that next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, Another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. In the chat, somebody's asking me, am I still sore from skiing? Yes, I am actually. So, funny story. I told Brent this morning I didn't have any funny stories, but I didn't want him to have any lead into this, so I get a good reaction. It is time to get rid of daylight savings time.
Amen.
Amen, right? We got to get rid of daylight savings time, and I'm going to tell you why. So my flight, this year, everything, it's funny. Everybody talks about how, the economy's slowing down, the consumer's tapped out. So when my family decided they wanted to go skiing this year, my wife goes to book this. Everything is booked up. I mean, completely booked. So normally where we go ski Solitude or Taos, wherever, and completely booked up. Everything's done. And so she's looking around. She finally finds some spots open and at Beaver Creek in Colorado. And so she schedules the flight. The flight leaves at 4:15 on Sunday morning. Okay. And that's not the funny part, Brent. That's not the funny part. That's just sad. Okay. Now, I'm okay with early traveling. I like it, right? Because you get there early, you got your whole day ahead of you, right? So it's easy, right? So, and there's no traffic going to the airport, no problem. So I go to bed and I set my alarm for 2:30. So I can get up, get everybody together, get them, and there's like 8 people that are going, so we can't take any of our cars, so I have to rent one of those little buses that come pick you up, and so to get everybody's luggage and everything in the car. So schedule him to show up at 3 o'clock. So he's going to pick us up at 3, takes the airport, gives us time to get through security and all that, get onto the boarding at 4:15. It's all going to be fine. Set my alarm for 2:30, go to bed. It's wonderful, right? Got everything in place. It's great. I wake up to the phone ringing, and I pick up the phone, and it's my driver, and he's saying, "Where are you? It is time to go. We've got to get to the airport." And I look over, and it's 3:05, and I'm like, "What happened to my alarm?" Well, apparently, when daylight savings times happens and we move forward an hour, the alarm at 2 o'clock, it goes to 3 o'clock. It just skips a 2:30 alarm, right? It doesn't reset the alarm for 3:30 or 2:30 or whatever, right? The clock just skips it all together. So my alarm never went off because we jumped forward an hour, totally forgot about it being that. So now it's this, and the one thing I hate in the morning, this is why I get up super early, is I hate being rushed in the morning. That's my thing, right? I like to get up, take my time, get dressed, whatever I'm going to do, get my stuff together, come to work, whatever. So always get up. That's why, I get up really early in the morning. I don't like to be rushed. And so I had it planned. I was going to get up, take a shower, because I hate traveling when I haven't showered, right? Because I got a beard and I don't like that. And so I was going to get up, have my shower, shave, get all dressed, travel. This will be fantastic. No, don't get to do that. It's just grab everything, run to the door, get out there. But all worked out well. This is one of the few trips where that was the worst thing that happened. Normally, like we're missing, like flights are getting canceled. Somebody's getting injured. My son had his appendix burst. Generally, I have really good, skiing stories, and this year, the only one I have is that, and the fact that the runs in Beaver Creek are extremely long. And if you're skiing, that's completely fine. When you're snowboarding, it beats the hell out of you. So yes, I am a tad sore. Well, I'm not anymore, but it's for a couple of days there, I was pretty beaten up. But yeah, it was a good trip, and so glad we're back. And yes, Larry asked how I would look with the Santa beard. The problem is that so after traveling, so I got up, traveled, got there, and of course, I was just at that point, I was just like, screw it. I'm just going to shave in the morning when I get up before I go skiing. And so when my beard grows in, it's all white. So yeah. So my beard has gone gray way before my hair. My hair's catching up, but my beard is almost completely white now. So it's age is setting in. So maybe when I turn 60 this year, I'll just grow a beard and be done with it. So we'll see. Anyway, all right. Anyway, got lots of stuff to get into. I missed you guys last week. Glad we're all back. It's always nice to get back to work. I enjoy doing this. Yes, Sonny Bono collided with a tree. While I was there, actually, in Beaver Creek, they were searching for a young man that disappeared, and he was a snowboarder. They finally found him. He died, unfortunately. He fell in a tree well. So he got buried in the snow, and they couldn't find him for several days. But yeah, so it's skiing. I always explain this to my kids because my kids are just, they're young. They have no fear of death like I do. And so they're like 900 miles an hour they're straight down the mountain, right? It doesn't matter what it is. Me, I'm very slow. I take my time going. But yeah, they're just straight down the hill. And I would say, like, be careful. Skiing is not risk-free. And, there's a good friend of mine, Ed Hindy, lost his son to a skiing accident, ran into a tree and killed himself, got killed by running into a tree. So skiing is not risk-free, and certainly happens. So anyway, big concerns over the weekend. This was kind of the topic of the newsletter this weekend. Again, as we talked about earlier, fastest sell-off that we've seen in quite some time. Everybody immediately kind of on edge. And again, I get it, right? It was a sharp decline. As, it was like every day, tariff on, tariff off, tariff on, tariff off. Makes it really, really hard on markets when you have a lot of policy uncertainty. And of course, as I was saying earlier, we've always got to come up with a reason. Well, why is this happening? Sometimes it's just because, right? And there's not really a reason. It's just, people are selling, markets reverse, get overbought, you run out of buyers, and it really can be just as simple as just a reversal. And that's a lot of what was happening last week. But again, show this chart, Brent. This was the headlines this week, is that recession fears are on the rise. This was a chart that was put out last week. So all of a sudden, we've got no fear of recession, and now everybody's fearful of recession because the market declined by 10%. Again, we just have to assign a reason to why the markets are declining. It makes us feel better as humans, right? It's like, oh yeah, that makes complete sense, right? So markets are declining because of that. But is there really a sharp rise in recession risk? And the answer is that we don't really know, right? The reason that people are assigning a recession risk to what's going on right now is because they go, well, Trump's tariffs are recessionary. There's no really evidence of that. We did tariffs in 2018, 2019. Didn't have a recession until we physically shut down the economy, and because of the pandemic, had nothing to do with tariffs. If it hadn't been for the pandemic, probably wouldn't have a recession. We had tariffs back in the last time we really had tariffs of any great consequence were back in the 1915s, early 1920s. Economies did fine. So there's not a lot of evidence that tariffs cause recessions, but it's a reason, right? And so we're trying to assign a reason to things. So Trump's tariffs are going to cause a recession, right? Now, there's certainly some evidence out there that the economy is slowing down, but this isn't anything new to you. We've been talking about this now for a year, been writing about this for the last year, is that all of this economic growth that we saw in 2021, 2022 is because of massive amounts of government spending that is now reversing. And so we're going to have slower rates of economic growth. The economy is going to slow down as that money gets extracted from the economy. So what's happening there is exactly what you expect, but that's not necessarily recessionary. That's just slower economic growth as you have a reduction in spending. Consumers certainly getting on edge here a bit. starting to have, less money to spend. So they're starting to contract a bit on their spending. We're definitely seeing that through a lot of different metrics. But again, those aren't recessionary just yet. And on Friday, I'm going to do an expansion of kind of what I covered in the newsletter this weekend, go a little bit more in detail. Because the question of recession is a big driver for markets, right? Because the reason is that what moves market prices, right? It's not recession fears. It's not tariffs. It's not policy. Those things do not drive market prices ultimately. What drives market prices ultimately is earnings. And that's why when you take a look at earnings, there's a very high correlation to the expectation of earnings versus the direction of the markets, because markets are simply repricing based on earnings growth. I'm paying X for Y in earnings, that gets my PE. Okay, so whatever earnings are ultimately, and again, what drives those earnings revisions is important. But that's what markets trade off of, is what are driving earnings. So when we come back from the break, we'll take a look at a couple of economic indicators, and we'll talk a little bit about what's going on, and do they really suggest a recession is on the horizon? What are those risks? And what does that mean for the markets? Talk about that next.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm sure when you were growing up, your parents said, don't get in a car with a stranger, especially white vans with no windows on them. Don't get into those if they're offering candy.
The Real Investment Show podcast.
And then now we've evolved to this point. It's like, we can order a stranger with a car to come pick us up off of our phone. Uber just announced that they are opening up a wait list for Waymo rides in Austin. This is the driverless taxis, which is cool.
At realinvestmentadvice.com.
So now I'm not going to get into a car with a stranger. I'm just going to get into a car with no driver and watch a Roomba go around Austin trying to navigate busy streets.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is, of course, Monday as we get the second half of the month of March underway. And this is also, by the way, the beginning of the last really kind of 2.5 months of the seasonally strong period for the market. So the last half of February, first half of March tends to be fairly weak historically. And this month today and this Friday is options expiration day. So we'll have to get through that. But starting today is the beginning of the stronger half of March, and then April tends to be a fairly decent month. So, and then May, and then we get into sell and May go away thing. So that'll be a whole nother conversation when we get there. But talking just for the break, though, lots of headlines out over the last week talking about recession risk on the rise. Why? It's because of tariffs, whatever the reason is. And again, this is more headline narrative. It's also really important where you're getting your headlines from. There's obviously a large swath of the media that just doesn't like Trump. So whatever he does, right, it's bad. So it's going to cause a recession. It's going to be bad. Whatever he's doing is bad. This is all bad. So you got to be careful and get back to just looking at the data. So I'm going to show you a chart here. So this chart is a little bit layered, so I'll explain it. And if you're driving, don't worry about it. I'm going to explain it enough for you to visualize it mentally. And then you can always download the weekend newsletter off the website when you get to work or home, wherever you're headed to right now, and see the charts themselves. But we have built an economic composite index. This economic composite index, and in the chart, it's the black line, is comprised of about 100 subcomponents of the economy. Hard data, soft data, and the difference between that is soft data is services, basically, and for all intents and purposes. It's things that aren't an actual production of something. Hard data is things like manufacturing data, right? That's hard data. We can measure it, we can touch it, we can feel it, we can do those type of things. Services data is a lot of times it's more about sentiment. And so there's sentiment indicators in this as well. So, but this is a very broad index of the economy, and it has a very high correlation to really the ebb and flow of economic growth over time. And going back through history, the red line is the 6-month rate of change of the leading economic index, which is produced by the government. That indicator, the 6-month rate of change, has a very, very high correlation to the economy itself and has a very high correlation to the Economic Composite Index. And these two indicators have a nearly flawless track record of predicting recessions until 2023, right in there. The economy kept growing, and these indicators went negative, says we should have had a recession. We had inverted yield curves, should have had a recession. We had a variety of indicators coming out, manufacturing indexes, et cetera, all in negative territory, saying we should be in an economic recession in 2023, 2024, should have been a recession. Didn't have one. And the reason, of course, was because of the massive amounts of government stimulus that were flowing into the economy that kept the economy going, right? This was the CHIPS Act. This was the Inflation Reduction Act that didn't actually reduce inflation, but hey, it was all there for you. But all that money that got spent kept the economy in positive territory, which was the first time that these indicators were wrong. And they were wrong. Here's the problem. These indicators are now back in positive territory, suggesting that the economy is back on a growth mode again. But now we're getting headlines saying we're going to have a recession. So are they wrong again? You know, this is the challenge that we're going to have going forward here for a little while, is getting this data back into some level of normalcy where we can actually use it and say, this is telling us something relevant. But if you have an indicator that is now 95% accurate, historically speaking, versus 100% accurate because it was wrong once, right? Is it just wrong now forever? And I would suggest that the answer is no, that it's not wrong forever, and that we are going to slow down. And what this indicator is telling you right now is that it's barely positive. But it's positive. And what that tells you is that the economy is going to grow at a slower rate, but it's not going to be recessionary. Now, again, we've got a lot of things that we're still processing through from, previous, all the spending that was coming in. Now we've got a government that's looking to try to cut spending, reduce government employment, reduce immigration, those type of things. Those all have negative economic impacts. Doesn't mean recession, but certainly means slower economic growth. Could it be recessionary? Yes, absolutely. But as investors, we have to have something that we can work off of rather than just assumptions. We can run around and just assume the best of things or the worst of things, but those don't really work out well when trying to invest and manage your portfolio. So we have to have some data that we can work off of and say, historically, when this has happened, this leads to this outcome. And why is this important, right? Because all of these things relate back to what? The one thing that drives markets. And what's the one thing that drives markets? Earnings. And if earnings are a function of economic activity, then a recession is certainly very, very important. Because if I'm having a recession, that means I have negative economic growth, which means I'm going to have a negative impact to earnings. And we'll see what happens. But if I have slower economic growth, that does mean that I have slower earnings. So maybe the market doesn't grow by 20%, but that also doesn't mean that the markets are going to decline into the abyss either. So these are the things that we've got to try to work through as we look forward into the economy this year, because the strength and direction of economic activity is going to lead to the strength and direction of earnings growth, because earnings come from economic activity. Earnings is what drives the valuations of markets, ultimately the prices. So this is the thing we'll have to be challenged with. And again, if we take a look at the long-term historical correlation between earnings and the annual rate of change in the markets, it's about a 90% correlation. It's very high. So the point about this is, the takeaway I should say, is that set aside the recession calls for right now, because the data doesn't really support a recession. It does suggest we're going to have slower economic growth, which is going to impact earnings. Earnings are still way too elevated. We just wrote an article recently on the website, just like 2 weeks ago, talking about Wall Street's more exuberant forecast of earnings. those are going to have to come down. Now, we've already reduced those a bit. Just in a month, we went from $289 a share in earnings for 2026 to $284. So we've already clipped $5 off. That's not a huge discount. The long-term growth trend of earnings is around $200 a share, $220. So, I mean, you're at $220 versus $290-ish, right? So that's a big drop potentially for earnings going into next year. Could certainly see that. But in order to have that kind of decline, we're going to need much slower rates of economic growth, and we're going to see that coming. So we'll see this action that's coming from the government. We'll see what's happening there. And we'll start to see those earnings reductions. And if we start to see those earnings reductions, that's going to lead to more concern about market valuations, and that's going to lead to choppier markets. So again, as we've been talking about since the beginning of the year, remember, right at the beginning of the year, we wrote an article called Curb Your Enthusiasm, saying that this year is going to be marked probably by more corrections, higher volatility, and lower returns. We just had a 10% correction. And I would not be surprised if this summer we don't see another 10% correction. Or 15, right? You're going to get a rally first. So the markets are too oversold, too negative right now not to have a rally. You're going to get some type of rally. Question is just how big of a rally do you get and what's the opportunity you can make out of it. But you're going to get a rally here. I would be very reticent at this moment about both shorting the markets at this level as well as selling at this level, right? Both of those are more emotional driven than anything. Lots of negativity in the markets. And when you have investor sentiment as negative as it is now, the investor sentiment, as we showed in, kind of talked about in last week's daily market commentary, investor sentiment is so negative right now that it's normally at levels where you have seen a 20% or more correction in the markets, and we're down 10. You very rarely see investor sentiment as negative as it is right now, where you don't get a rally. Again, doesn't mean the markets are going off to new highs, but a 3, 4, 5% rally, we just saw 2% on Friday, would not be surprising. That's the opportunity to sell and rebalance into, reduce your risk if you need. Because again, as we get into the summer, I think there's a real shot here we get another bout of volatility before we kind of work through what tariffs mean and what this means for the economy, what that means for economic growth, and ultimately what that means for earnings. Okay, quick break. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisor's Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Question in the chat, does Brent use RIA products? Yes, he uses our hair gel, our face creams, etc. Absolutely. The man has just, if he shows you himself on camera, you just see the locks of hair he has from our hair gel, which is guaranteed to work to help you grow hair. Grows hair, absolutely. So, no, good question in chat. If tariffs go into effect 4/2 on April 2nd when they're expected, so some of the tariffs that have been announced, they got delayed until April the 2nd. He didn't want to do it on April the 1st because he was worried that people would start making April Fool's jokes out of it. So April the 2nd. Does that mean the markets will crater again, or is that already priced in? This is the thing about tariffs. The mistake that President Trump is making is so let's back up real quick. Is Trump incorrect about tariffs, immigration, etc.? Absolutely not. He's 100% right on everything he's saying about tariffs, that, basically every other country has tariffs on our products. We don't tariff them. And he's been working towards a free and a better trade balance between, if you're going to tariff us, then we're going to tariff you back. So take your tariffs off. That's the end goal of this. Quit tariffing our products and we won't tariff you. That's all he wants. Make it fair. If I'm shipping a product to India, don't tariff me 100% on that product so that people buy Indian products versus U.S. products. Make it fair. Canada has tariffs on our products already. Right? All we're doing is saying, hey, if you tariff us, we're going to tariff you back. So he's absolutely 100% correct in what he's doing. His mistake is how he's doing the tariffs. And when I say by the mistake he's making is by how he's doing the tariffs is in relation to the stock market only, right? Only in relation to the stock market. He's using his tariffs right now to negotiate with, and that's completely fine. He's doing the correct thing there. But when it comes to the stock market, no. And the reason is that the market has to be able to determine what the tariff means to corporate earnings. Again, what drives markets? Earnings. It's not the tariff. It's the earnings. It's the impact to earnings. It's the impact to corporate profitability. That's what the market cares about. It's not the tariff. It's the impact. So if he would just come out and say, look, on January the 1st, whatever, February the 1st, if he would have just got into office, February 1st, I'm putting a 50% tariff on everybody. And then don't change it. The markets would have said, okay, bad. Would have had an initial kind of knee-jerk correction while the market started going, okay, a 50% tariff on all these products. That's going to be this impact to these industries. These industries are going to take this much cut to earnings. If I cut earnings on those companies by $10 a share, what's the valuation now? We're at 23 times earnings. That puts it at 21 times earnings if they grow, or 25 times earnings, and I don't want to pay that much, so the price has to come down in the market, so we get a reversion in valuations back to 23 times earnings, and then the market gets to grips with that. And so you go through this corrective period as the markets start to adjust for that 50% tariff. Maybe that takes a week, maybe it takes a month. But then once he comes to grips with that, it's okay. It's priced in, it's factored in. I now know what it's going to be. The mistake that Trump is making with the tariffs is, well, I'm going to tariff you 50% today. Nah, tomorrow I'm going to postpone it because, this is happening. And so markets can't come to grips with that because, again, I've got an impact today. I don't have an impact tomorrow. It's more of an impact because he changed the tariff rate. It's less of an impact because he changed the tariff. It's this moving target of tariffs for the markets that are making it difficult. Markets are trying to account and adopt for the impact of tariffs on earnings, but it can't because it constantly changes. And so markets are going through this corrective phase right now, just trying to throw a dart at saying, okay, I just need to get the valuations down. And we've had a very, very sharp reversion in valuations over the course of the last really kind of 2 weeks, 3 weeks in particular, really kind of ever since the end of February. So we've had a pretty sharp reduction in valuations because of this market sell-off, but earnings really aren't changing yet. Again, we've only dropped 2026 earnings by $5 a share. They're still very elevated. So there's not a big concern about the impact of economic growth going forward from tariffs because it's not being reflected in earnings, at least not yet. But if Trump wanted to stabilize the stock market, just pick a tariff rate and stay with it. So again, April the 2nd, tariffs go into effect. Great. Don't change it. Just let them go into effect. The markets will adapt to it. The markets will adjust in price, and they're already doing that right now. Because right now, the expectation is the tariffs are going to effect April the 2nd. So markets are already pricing that in. They're already factoring that into the valuations. They're factoring that into earnings and corporate profitability. And then once those tariffs go into effect, fine. But if you come back and you change it again, markets are going to have to reassess. And so it's this on-again, off-again impact of tariffs that are weighing on the markets because markets are just trying to reprice for earnings, but again, it's a moving target. And what markets need are stability. So again, there's nothing wrong with the policies that he's enacting. They're all good for the economy in many ways. And it's very fascinating to me too, because all the people that were like a year ago complaining about the debts and the deficits, the excess spending, we're going to have this massive crash because of the debts and the deficits. Now you've got a guy in office that's working on reducing the debt and the deficits. Now you're complaining that the reduction of the debts and the deficits are going to cause a recession. Well, you didn't get, as we talked about before, the country didn't get fat on debt overnight. You're not going to get skinny overnight in debt without some pain, right? So you can't have your cake and eat it too. But the things that he's doing will make the economy better long term by reducing debts and deficits, which is what you wanted. But again, as we've always talked about here on the show, is that people always say this is what I want until they have to get it. And then it's like, well, I don't want the pain, right? And this is why cutting spending is always so very hard, because nobody really wants to cut spending because going on a diet sucks. And that's what's happening. But again, what the markets need is they need stability. Pick a tariff, stay with it. Pick a debt reduction, stick with it. Whatever it is. We're going to do X, stay with it. And that's because the markets will price that in pretty quickly. Whatever the expected impact of a tariff, of a policy, whatever it is, the markets will price that in very quickly. And again, as we've talked about on the show before, the thing that gets the markets is never the thing the market knows about. I'm writing an article for the next few days for next week about Ray Dalio. Ray Dalio's out and all the headlines going, oh, we're into an inevitable crisis. The debt and the deficits. It's going to crash the economy. I went back and I pulled a bunch of previous headlines. Do you know he was saying the same thing in 2010, 2012, 2014, 2015? I mean, he's just a repetitive machine, right? The debt and the deficit, it's going to crash. It's going to crash everything. All right. So we got a guy in office now that is going to fix it, but you don't like him personally for whatever reason. So now you're bashing him because he's trying to fix the debts and deficits. It makes no sense. But this is the messaging that goes on in the economy. And this is why, as investors, we have to set a lot of stuff aside. And when you hear people, Paul Tudor Jones last year, right? I don't want to own bonds. Bonds are one of your best performing assets this year. Be careful with who you listen to. Just because they're a big name, just because they manage a lot of money, doesn't mean they're always right. You know, you have to do your work, do your assessments, do your analysis. You know, I'm not right all the time. You're not right all the time. Nobody's right all the time. If we were, nobody would be doing this. We'd just all be sitting on a beach somewhere. But do your homework, right? Especially if you're managing your own money. If you're not hiring an advisor to manage your money for you, then and you're doing it yourself, completely okay. Get yourself a good set of tools, and most importantly, have an investment policy statement. We talked about the importance of that before. You know, have a set of rules that you're following to keep you out of trouble so that your emotions don't drive your portfolio allocations, because that's what's happening in the markets right now. People are panicking because the markets are down 10%. 10% is an average correction. It's a median correction going back 130 years. And every year, your risk of a 10% downturn every year is up to 10%. 5 to 10%, completely normal every year. Happens almost every year. Sure, there are times when that 10% becomes a 20%. That's much more rare. 13% of the time. So don't let minor market corrections drive your investment policy decisions. Again, our whole job as investors is to buy low and sell high, right? Well, here's your opportunity. All right, wraps up the show for today. Be back tomorrow with John Penn as we get this week underway. See what the market does today. We'll catch you up tomorrow. Have a great day. Get by the website. Daily market commentaries out, newsletters out, all on the website, BillInvestmentAdvice.com. Like and subscribe to the channel. We appreciate you. See you back here tomorrow.